Now we're going to turn things around a little bit and let's focus first of all on the story around Fitch rating of Nigerian states. Of course, they have re-rated or rather updated their ratings on Lagos, Kwara and Kaduna states, and the rating agency has revised the state of Lagos national long-term rating to positive from stable and affirmed its AA rating, citing improvements in transparency and debt management. Joining us on the line to review the rationale for the ratings review is Rafael Carnevali. He's a senior director at Fitch Ratings. He'll be giving us his thoughts on that. Rafael, it's great to have you on our show, and maybe a good place to start is to get a sense of why Lagos was the only one that you've re-rated as or rather, you have put you have updated the outlook for the state as stable, as positive.
Hello,
rather.
Good afternoon. Well, Lagos was revised yesterday.
Yes.
And it got a positive outlook from stable, but
yes.
We are monitoring all other states. So over time, other outcomes may come from Rivers, Akwa Ibom. As for others, we withdrew the rating of Kwara because the state opted no longer participate in the rating process.
Right.
And for Kaduna, we affirmed the rating because they have been on a stable performance and declining in debt.
All right. So you obviously like a few things about Lagos State. I think there's a key focus on transparency and its debt management. Lagos State, of course, has been approaching the Nigerian capital markets recently to raise capital. I want to get your thoughts on the possibility, or if you like, maybe we can play with the idea of perhaps even accessing the international capital markets, considering the fact that they may just be able to get debt at lower rates. What's your thoughts on that point?
Well, if they want to access the international capital markets, it's their choice. From our point of view, we can point out that the rating is improving a bit, and this is based on two main developments. One is the improving management transparency, and the second one is the budget performance, which we think will improve over time. As far as the transparency is concerned, we have been able to see more disclosure. For instance, now Lagos has quarterly reports available also sometimes on the internet, and this is a major development compared with when we started the rating in Lagos in 2009. Also, the state has switched from purely depending on bank loans, local bank overdrafts, to issuing bonds. And this helps the debt management in the sense that now Lagos has fixed repayment scheduled with the bond issues, longer maturities. There are bonds having 7 years of maturity, 5 years of maturity. And also there are monthly provisions into the debt reserve fund, which helps accumulate resources to pay the debt when it comes due.
There's an expectation that Lagos State would at some point begin to produce oil. Did you bring this into your evaluation at any point at all, or is this a pure play on the diversification of the economy and of course what they can raise from taxes?
Sorry, you said oil?
I wanted to get your thoughts on whether or not the prospect of Lagos becoming an oil producer was something you factored into this rating at all.
Not at all, because as far as we know, Lagos has an economy which is pretty much based on commerce, not on oil. If it comes, well, it will add to the diversification. But we didn't take into account oil revenues specific for Lagos, on top of those that it already receives from the federal locations.
Okay, you just mentioned that some states appear to be discontinuing participation in the rating. Clearly, Lagos stands out in Nigeria in terms of its diversification, the fact that it can get so much revenues from taxes. What would you say the other states have to learn from Lagos in terms of how it has positioned itself? Clearly, it's in a very good place given its history as a commercial nerve center of the country. But what else can the other states in Nigeria learn from the Lagos State project, if you like?
But some of them are really learning from Lagos, or anyway learning from the push that the federal government is exerting on them to increase the internally generated revenues. For instance, Kaduna has shown a steady growth in taxes is not as big as Lagos, but anyway, for a state which started with internally generated revenues very low in the past, we really appreciate the development. And then the other states that we cover, Akwa Ibom has a weaker economy, and therefore internally generated revenues roughly represent 10% of their annual income. But in Port Harcourt, in Rivers, the situation is a bit in the middle between Akwa Ibom and Lagos. Their taxes represent roughly 30% of the annual income. So states are really pushing on tax collection to diversify their revenue source. Of course, when you have the partial removal or the full removal eventually one day of the fuel subsidy, this will for a while increase the dependence on oil.